Namaste to all, dear students. Here I am with a video on ratio analysis. This is very important topic. It will not leave you at any stage of your life as a commerce students. And most important thing for the decision making by the management. So uh, this video is for mm, become second year students, general students, and for BBA first year, second semester students, especially for them, and who are having ratio analysis topic, they all can use also, but it is specially for them. As ratio analysis is a topic which is very important for financial decision making and financial planning, because what is ratio? What is ratio? Ratio is a thing which describe the relationship between two things, two objects, uh, two variables, two numbers in simple. Okay. Presently, I'll make you it easy. Presently, in India, not only in India, everywhere in the world, epidemic called Corona. Okay, COVID-19 nickname for it, coronavirus. Okay, uh, all over the world. Suppose, for example sake, you take mortality rate, death rate of corona affected people is, let us say, 2%. So out of the 100, every two people are getting the gift of death by the corona. That as simple as that. Out of 100, it is 2. We can easily say it is 2%. It is 2% by telling only 2% only now, but uh, it is very big thing. Suppose number of people getting affected is more, the number of people who are dying is also will become more, though it is 2% itself. So some things with ratio we can easily understand, and sometimes it is not 100% we could rely only upon the ratio itself, because sometimes it shows there are some limitations also for the ratios. Okay, let us continue the topic. Suppose the same thing. Suppose out of 1,000 cases, if 15 are getting death, dying, are 15, then 15 divided by 1,000 into 100, it will be 1.5%, isn't it? Suppose if it is 10,000 people, and suppose uh, 300 are getting affected, 300 divided by 10,000 into 100, it will become 3%. As the number of sample is getting increased, it is changing, though it shows 3%. Sometimes in some the same example, I said generally it is 2%, and in a country 1,000 people out of 15 are dying, then it is 1.5, less than the 2% which is industry, uh, or which is global rate. And some other country 300 out of 10,000, then it is becoming 3%. So percentage wise we can easily analyze which country is getting more affected and which country is getting less affected, but we cannot justify it only based on the percentage itself. Sometimes we can justify, sometimes we cannot. Okay, there are some limitations. We will discuss those limitations also later. Okay, sometimes absolute values we need to know. Sometimes uh, by ratio we can easily understand the thing. The thing here, ratios tells the uh, clear uh, picture in a small quantitative number method. So in this chapter we are going to study ratio analysis, types of ratios, application of ratios and analysis in decision making, ratios of financial management with other disciplines of accounting. दूसरे financial से related, I said just now management accounting is there. Management need to make a decision. Okay, suppose I'll tell one example here itself. Suppose when you compare advertisement expenditure with your sales, 10% previous year it was 10%, as out of the total sales advertisement expenditure is 10%. Okay, and presently it is 15% as compared to the previous year. So present year how much it is increased, 5% increase is made in the expenses related to the advertisement. But because of that we need to analyze another thing also, how much sales have been increased. Suppose compared to the previous year, present year sales have been increased by 5%. It is a good achievement, as there is a 5% change in the advertisement expenditure. There is a change in the sales also by 5%. It may lead to more profits. So these, whether to go for more advertising or not, all those decisions has to be taken based on these ratios itself. So it is useful for the other disciplines. And what is cost related, how to control the cost, those all will be taken care with the help of ratios. So ratio analysis will help the other disciplines like cost accounting, management accounting and others. And financial management is one of the branch of management accounting. So types of ratios we are having: liquidity ratios, liquidity ratios are short-term solvency ratios, leverage ratios are long-term solvency, activity ratios are efficiency ratios, or performance ratios we can call profitability ratios. These are the categories of ratios. One is liquidity. Leverage ratios are long-term solvency ratios. Solvency means survival of the organization or business unit, or survival of the entity, how it is in short run as well as in long run of the enterprise. These ratios will help to make the decisions whether we can get more long term funds, or whether adequate working capital is having or not. Liquidity ratios will help. Activity ratios means it is relating to operations of the business. Activity ratios or efficiency ratios or performance, how business is performing. Okay, those will be determined by the activity ratios. And profitability ratios, every business one of the objective will be the profit, and that is the prime objective. So how profitability of the organization is there, and related ratios we need to see. Okay, these are the various types of ratios. This is about our chapter. This is the overview of our chapter. Ratio and its types. Ratio analysis is a comparison of different numbers from the balance sheet, income statement, and cash flow statement against the figures of previous year or other companies or the industry, even economy in general, for the purpose of financial analysis. See, for financial analysis purpose, ratios will be used. As I said, I took one example of uh, previous year advertisement expenditure compared to the current year. So with the previous year or with the our company with the other company of similar business or industry as a whole, what is the ratios, and our business is where among the industry. So ratios will help in these decision makings. As I said, we need to discuss the types of ratios. Liquidity ratios are short term solvency ratios, long term ratios are long term solvency ratios. In long term, also, there are two types. One is capital structure ratios and coverage ratios. What is the risk and return? Those we need to see under leverage ratios, how much we can get outside funds for the business. Owners fund and outsiders funds, that is borrowings will be there. How much we can have outsourced finance, and what how it should be repaid. All those things we need to analyze with the leverage ratios. Liquidity ratios are nothing but relating to current assets and current liabilities. These are for the day-to-day operations of the organization, management of the organization. So operations of the business, short-term solvency will position will be determined with the liquidity ratios, and activity or performance or turnover ratios. As I said, comparison with the operations perform sales with the other expenses and other things, and profitability ratios related to sales, related to overall uh, return on investment assets, that is capital employed or equity, that those are related with the profitability ratios, and required for analysis from owner's point of view. What is owner's equity, how much return he is getting as a dividend, and what is the market price related to investors valuation, the person who are investing in our company. Okay, all these things will be analyzed with the ratio analysis. So here is one summary of the ratios. Let us see this. First, liquidity ratios. Under that, current ratio, current assets divided by current liabilities. What one comes under current assets? Current assets includes uh, short-term short-term investments, inventories, sundry debtors, bills receivable, prepaid expenses, uh, any income accrued or interest accrued like that, and short-term loans and advances plus closing stock. These all comes under current assets. Similarly, current liabilities means sundry creditors, bills payable, bank overdraft, outstanding expenses, and uh, mm, some income received in advance. This all comes under current liabilities. So, a simple measure that estimates whether the business can pay short-term debts. It is nothing but can a business unit is able to meet its short-term uh, liabilities. Okay, so for that purpose, this ratio will be useful. That is why it is also known as short liquidity ratio or solvency ratios. Short-term solvency position it will see. So ideal ratio, current ratio is 2:1. This thing we need to remember here. Ideal current ratio is 2:1. If your current assets are 2, then your current liability should be 1. Or if your current liability is 1, then you should have current assets of 2. In simple words, if you are having a liability of 1 rupee, you should have in 2 rupees in your pocket. That's what it means. This is about current ratio. Next is quick ratio. Quick ratio is nothing but quick assets divided by current liabilities. It is a measure the ability to meet the current debt immediately. Means from the assets we ignore, we don't consider two assets, prepaid expenses and closing stock. What is quick assets means current assets minus current assets, I repeat, current assets minus closing stock minus prepaid expenses. Whatever you will get, that will be your quick assets. Quick assets divided by current liabilities will be your quick ratio. Means all of a sudden if your short term lenders or creditors come and say let us pay, otherwise we will not allow you to run your business. So that is the position of quick ratio. So 1 is to 1 should be the ratio. If you are having a liability of 1 rupee, you should have 1 rupee in your pocket. This is called as quick ratio or acid test ratio, people will call. Next, cash ratio or super quick ratio also we can call it as super quick ratio. Cash and bank balances plus marketable securities, these three things we need to include divided by current liabilities. It is measure absolute liquid of the business. So what is the uh, your present capability of paying your debts? All of a sudden something happens, how much cash and marketable securities bank balance you are having to meet those expenses. So that is called as cash ratio or super quick ratio. Next one is basic defense interval ratio. Means this is the ratio. It measures the ability of business to meet regular cash expenditure. Regular business operations will take some expenses. For that, to meet that expenses, what is your assets you are having? Current assets, that is cash, bank balance, marketable securities divided by operating expenses equals to, that is not minus, it is equals to number of days. It basic defense interval ratio will be measured in terms of days. So how many days you can meet your regular cash expenses, that is what we are going to basic defense interval ratio. right? That is nothing but, suppose now there is a lockdown in the uh, state. So suppose after 14 also, if lockdown is continued, how many days people can uh, be locked down with the present, the financial position the state is having, as well as the each individual is having in general, that is measured. So that is nothing but, here we are seeing cash, bank balances, marketable securities divided by expenses, operating expenses of business. How many days? It will be known. Next one, net working capital ratio, current assets minus current liabilities. It is measure of cash flow to determine the ability of the business to survive financial crisis. That is nothing but current assets minus current liabilities. How much excess amount we are having, that will be known. These are the liquidity ratios. If anyone want to make a screenshot, they can make of it. Presently I am एंडिंग द वीडियो हियर. अभी बहुत हो गया, फिर ज़्यादा पढ़ा है तो भी ऊपर से चले जाएगा. सो आई रिक्वेस्ट एवरी वन टू बी एट होम and stay at home. That is the remedy we are having against the coronavirus. So stay at home, be safe. सीखना बंद तो जीतना बंद, तो सीखते रहिए जीतने के लिए. जय हिंद.